Imagine generating over $300 million in revenue in a single quarter.
Oh, wow. That is a lot of cash.
Right, your sales are breaking records, the market clearly wants your product, and you are like celebrating massive top-line growth, and then you look at your bottom line.
And the reality sets in.
Exactly. You realize you are actually losing money. Today, we are looking at how a tech-driven financial platform can look like an absolute powerhouse from the outside, while, the internal engine tells a drastically different story. Welcome to the Deep Dive.
Glad to be here.
It is May 18th, 2026, and today we are skipping the glossy marketing slides. We are looking directly at the raw data you shared with us specifically, the highly detailed financial appendix from Upstart's Q1 2026 investor presentation.
Which is honestly arguably the most important place to look if you want to understand what is actually happening. A financial appendix is generally where companies bury the realities. They don't really want to put in big, bold font on the first page of their slide deck.
Yeah, they hide the vegetables.
Right. It is dense, it is filled with accounting jargon, and it requires you to kind of read between the lines to see how the financial machinery is truly operating.
And our mission today is to cut through all that noise. We're going to decode the real financial health, the actual growth strategy, and the hidden risks of this AI lending platform. So, okay, let's unpack this, starting with the most visible metric on the dashboard, the revenue.
Always a good place to start.
Because the top-line numbers here are undeniably massive, but the moment you look 1 inch deeper, the narrative completely flips.
The top-line trajectory is really what draws everyone in. Total revenue expanded from roughly $218 million back in the fourth quarter of fiscal 2024 to over $308 million by the first quarter of fiscal 2026.
That's a huge jump.
It is. That kind of steady, aggressive expansion is exactly what you want to see in a growth stage company.
And digging into the sources, what I found particularly telling is like the origin of that money. It's driven heavily by a surge in their core fee-based revenue.
Right, the matchmaking fees.
Yeah, exactly. These are the platform and referral fees they generate when loans are facilitated through their AI model. They aren't just taking on all the loans themselves, they are acting as the matchmaker. That specific stream jumped from $150 million in Q1 of 2025 to over $224 million in Q1 of 2026.
Which is a massive validation of their tech.
Totally. That tells you the AI is actively matching borrowers to lenders at an accelerating rate.
Yeah, and that matchmaking capability is the entire value proposition of their technology. When core fee-based revenue surges like that, it signals strong market validation. Banks and credit unions are actively utilizing the AI to make lending decisions.
But there is a catch.
A huge catch. The danger of only looking at revenue is that it completely ignores the cost of delivering that service. And that is where the financial picture begins to fracture.
Fracture's putting it mildly. I mean, they went from a very solid $31.8 million profit in Q3 of 2025, which had everyone celebrating, by the way, to a $6.6 million loss in Q1 of 2026.
Yeah, that's a harsh reversal.
That is a massive swing into the red in a very short window.
Yeah.
And you see it bleeding into all their margins. The operating margin peaked at 9% and is now flipped to a negative 3%.
Ouch.
Yeah. Even their non-GAAP contribution margin, which usually paints the rosiest possible picture, dropped from 61% down to 50%. It sounds like a restaurant that's busier than ever, selling out tables every night, but somehow losing money because the cost of premium ingredients and, hiring extra wait staff is completely eating the profits.
It's a great analogy, but with a tech company, it's even more severe. It isn't just the cost of ingredients fluctuating, it is the fundamental cost of operating the kitchen itself.
Right.
The shift back to a net loss happened because the operating expenses, specifically sales, marketing, engineering, product development, and administrative costs, are growing at a velocity that just outpaces their record-breaking revenue.
I mean, I can understand heavy spending on engineering. This is an AI platform. You can't just build an algorithm, put it on a server, and walk away. The AI brain requires constant feeding and refinement.
Sure, but that raises a critical question about the business model's ultimate scalability. Yes, AI models require highly compensated engineers and immense ongoing cloud computing resources to train and refine.
Which is not cheap.
Exactly. The problem is that investors buy into tech platforms specifically for their operating leverage. The promise is that once the software is built, servicing the millionth customer should cost practically nothing compared to the first.
Oh, I see.
But if your costs continue to rise faster than your revenue, you haven't built an infinitely scalable software company. You've built a very expensive, human-heavy consultancy wrapped in a tech interface. Managing those operational costs is the single most critical factor for their future market performance.
Which brings up an unavoidable problem for you as the listener. If your operations are burning through cash and your margins are flipping negative, how are you actually funding this massive expansion?
Right, you got to look at the balance sheet.
Yeah, this pushes us to look at the state of the company's actual assets. And the balance sheet paints a picture of a company leaning heavily into leverage.
It does. The balance sheet reveals a very aggressive posture. Total assets grew from $2.37 billion in Q4 of 2024 to nearly $2.97 billion by Q4 of 2025.
Wow.
That is significant asset growth. However, the funding for those assets tells the real story. Their borrowings climbed from $1.4 billion to over $1.9 billion in that same time frame.
Wait, hold on. They took on $500 million in new debt in just a few quarters?
Yeah.
Taking on that kind of heavy leverage when your core operational margins are turning negative sounds incredibly reckless. I mean, you are borrowing money to fund a machine that is currently losing money.
It is a calculated high-wire act. They are employing a strategy of leveraged expansion because they believe the long-term lifetime value of their AI model will eventually out-earn the current cost of debt.
That's a big gamble.
It is. The risk profile is undeniably elevated, and the complexity of that risk multiplies when you look at how those assets are actually valued on the books. A massive chunk of their portfolio is categorized as loans at fair value, which peaked at over $1.2 billion in Q3 of 2025.
Okay, here's where it gets really interesting and, honestly, where corporate accounting feels completely detached from reality.
Oh, for sure.
This concept of fair value is plastered all over the appendix. Wait, so you're telling me they can report a massive multi-million-dollar loss just because the hypothetical market price of their loans dropped, even if the borrowers are paying on time and no actual cash has left the building yet?
Yes. What's fascinating here is how non-cash accounting adjustments can utterly decimate a reported quarterly earning. Fair value dictates that a company must reevaluate certain assets at their current market price rather than their historical cost.
Okay, give me an example.
Let's say Upstart holds a portfolio of loans generating a 5% return. If macroeconomic interest rates suddenly jump and new loans in the market are yielding 8%, the 5% loans sitting on Upstart's books become significantly less attractive to potential buyers.
Because an institutional investor is going to look at that and say, why would I buy your 5% yield when I can get 8% anywhere else? So the actual value of that asset drops on paper instantly.
Precisely. To make that 5% loan attractive again, Upstart has to mark down the price of the asset. That markdown is a fair value adjustment.
Brutal.
In Q1 of 2026 alone, the fair value of their loans dropped by over $62 million. That single accounting adjustment drastically dragged down their net income. It wasn't operational failure, it was market gravity.
But that creates an absurd amount of volatility for anyone trying to evaluate the company. They could execute flawlessly, the AI could predict defaults perfectly, but if the Federal Reserve tweaks interest rates, their balance sheet suddenly looks like a disaster zone.
Exactly. That is the inherent vulnerability of this specific financial model. The reported earnings are hypersensitive to shifting market interest rates and secondary buyer demand.
Right.
Now, looking at the data objectively, the total fair value adjustment losses have actually narrowed. They peaked at a staggering $29.8 million loss in Q3 of 2025 and tightened to a $14.5 million loss in Q1 of 2026.
But even with that narrowing, the line items for unrealized losses and actual loan charge-offs, which is, debt deemed totally uncollectible, those remain consistently negative. It shows there is persistent underlying friction in the actual credit quality of the portfolio.
It does, and it highlights the ultimate tension in the room. If paper profits are being skewed this drastically by macroeconomic fair value adjustments and the operations are running at a deficit, how is the company physically paying its engineers?
Right, because you cannot fund payroll with a positive fair value adjustment.
No, you absolutely cannot.
You need actual cash, and that forces us to look at how the money literally moves day to day. Based on the cash flow statements, this company does not look anything like a traditional bank.
Not at all.
A normal bank originates a loan, sits on it for years, and quietly collects the interest. Upstart relies heavily on a category called loans held for sale. These are assets explicitly intended to be offloaded as quickly as possible, and the sheer volume is staggering. In Q4 of 2025, the proceeds from selling these loans surged to $2.68 billion. That generated a very healthy net operating cash flow of $108 million.
But the very next quarter, in Q1 of 2026, they aggressively reinvested in originating new loans, which immediately caused a net cash outflow.
So they aren't just acting like a traditional vault, hoarding money and collecting interest. They operate more like a high-speed conveyor belt, rapidly originating, packaging, and selling these loans to institutional investors just to generate the cash needed to fund the very next batch.
The survival of the business model is entirely dependent on that high-velocity recycling of capital. It is a dynamic asset cycle.
A dynamic asset cycle.
Yeah. They originate the loans, put them on the belt, and they desperately need the secondary market to be waiting at the end of that belt, ready to buy. The speed of securitization packaging these loans into investable products is their oxygen. If the secondary market freezes up, or if institutional buyers decide they don't want these specific types of loans, that conveyor belt stops.
And we are already seeing signs that the buyers are demanding more from Upstart to keep the belt moving. While they are furiously selling off loans, they're also building up a different category on the balance sheet, loans held for investment.
Right.
These are assets they hold on to earn interest. And that pile surged from $126 million in Q4 of 2024 to $438 million by Q1 of 2026. Plus, their restricted cash and beneficial interest assets are also climbing.
Which points to a very specific dynamic in the securitization market. Institutional buyers are essentially saying, we believe in your AI and we will buy these bundled loans, but we require you to keep some skin in the game.
Meaning Upstart has to commit more and more of its own capital as collateral. If the loans go bad, Upstart absorbs the first wave of losses. The buyers want proof that the company trusts its own algorithm enough to risk its own money.
Exactly. The conveyor belt requires increasing amounts of capital grease to function. They are forced to build up this portfolio and strategically execute these massive sales just to optimize their liquidity. They are continuously managing the tension between holding enough assets to satisfy buyers while selling enough assets to generate operating cash.
So if you're stepping back and looking at this entire picture, the rising operational costs, the $500 million in new debt, the high-velocity conveyor belt that could jam at any moment, and the multi-million-dollar volatility of fair value adjustments, you have to ask, how is Upstart actively protecting itself from a sudden market shock?
Well, they are heavily fortifying their balance sheet through strategic financing moves. In Q3 of 2025, they secured a massive $678 million inflow from convertible notes.
Convertible notes. So that's debt that the lender can choose to convert into company stock later on. Why go that route instead of just a traditional loan?
Because it is a highly effective way to secure growth capital at a lower interest rate. By offering the lender the potential upside of converting that debt into equity if the company's stock price soars, the company can borrow hundreds of millions of dollars without crippling themselves with high interest payments.
Smart.
Very smart. It was a proactive move to create a financial war chest. And it succeeded. Their ending cash balance remains incredibly robust at $931 million as of Q1 2026.
Nearly $1 billion in cash is a very comfortable fortress. And management clearly wants the market to know they feel secure because in Q1 of 2026, they allocated $100 million for stock repurchases. They are taking their cash and buying back their own shares from the open market.
Stock buybacks are the ultimate corporate signal of confidence. It tells shareholders, we believe our stock is fundamentally undervalued by the market, and we have the excess liquidity to invest in ourselves.
Makes sense.
At the same time, we see their stock-based compensation paying employees with equity instead of cash, holding steady at about $30 million per quarter, which further preserves that cash fortress.
So what does this all mean? Because I have to be honest, I am looking at this and seeing a massive, glaring contradiction.
Okay, play it out.
They have almost $1 billion in cash, and they are buying back $100 million in stock, which screams absolute confidence. But at the exact same time, the ultimate profitability metric in this appendix, adjusted EBITDA, just got demolished.
Did take a hit.
A huge hit. Adjusted EBITDA, which is a proxy for the actual cash flow generated by their core operations, peaked at $71.1 million in Q3 of 2025. By Q1 of 2026, it dropped to $40.4 million. Their adjusted EBITDA margin just got sliced in half from 26% down to 13%. Isn't the stock buyback just smoke and mirrors when your core operational engine is losing efficiency that rapidly? Isn't that a massive mixed signal for the listener trying to figure out if this company is actually healthy?
If we connect this to the bigger picture, the mixed signal is actually the most honest reflection of where the company is at today. You are absolutely right to challenge the buyback.
Yeah.
The liquidity reserves and the top-line revenue growth show a company that is successfully capturing market share and has insulated itself against immediate bankruptcy. They have the cash to survive a storm. But the shrinking EBITDA margin is the red flashing light on the dashboard.
Because adjusted EBITDA strips out all the accounting noise. It ignores the fair value adjustments, the taxes, the depreciation, and gives you a raw look at whether the core business of matching borrowers and lenders actually makes money.
And when that margin is cut in half, it proves that cost management efficiency is decaying. They're making less money on every dollar of revenue than they were 6 months ago. The stock buyback buys them goodwill with investors, but it doesn't fix the underlying unit economics. The critical variable for future performance isn't whether they can originate more loans, it's whether they can operate the AI platform without the costs completely cannibalizing the cash flow. They have the war chest to survive right now, but they cannot allow that operational margin to keep compressing.
Especially not in a macroeconomic environment where interest rates are constantly threatening the fair value of their existing assets. To quickly recap the journey we just took you on through this incredibly dense financial appendix, Upstart's AI lending platform is undeniably finding real traction.
Huge traction.
They are scaling their core fee-based revenue, which proves the market wants their technology. But beneath the surface, the engine running this growth is highly fragile. It requires an exhausting, high-velocity recycling of capital on that conveyor belt. They're taking on heavily leveraged debt, issuing convertible notes, and battling intense volatility from paper-based fair value adjustments, all while their core operational margins shrink.
The complexity of their balance sheet really strips away the illusion that a tech-enabled finance company is purely a software play. They are celebrated as a cutting-edge AI disruptor, but their financial survival mechanics rely entirely on old-school capital markets, debt management, and the constant appeasement of institutional loan buyers.
Which leaves us with a lot to think about regarding the future of fintech. Thank you for joining us on this deep dive into the numbers behind the narrative.
And as you mull over the data we unpacked today, I want to leave you with one final thought. If an AI-driven platform's profitability is so tightly tethered to the shifting fair value of macroeconomic interest rates, and its survival relies entirely on a high-speed conveyor belt of constantly offloading loans to cautious institutional buyers, at what point does a tech disruptor stop being an agile software company and start facing the exact same structural existential vulnerabilities as the traditional legacy banks they set out to replace?